The U.S. housing market is facing mounting challenges, with foreclosures becoming increasingly prevalent and buyer demand plummeting. A recent report from Atom Data Solutions highlights a concerning surge in foreclosure activity during the first few months of 2024, underscoring the financial struggles many American homeowners are grappling with. At the crux of this issue lies the staggering debt-to-income ratio for the average home buyer, which has reached an alarming level of nearly 40% of their gross income being dedicated to mortgage payments and other debts. This figure surpasses even the levels witnessed during the notorious housing bubble of 2006 to 2007, a period that ultimately led to a catastrophic market crash. With home prices soaring to dizzying heights and an increasing number of potential buyers being priced out of the market, the margin for error has become razor thin. Even a slight uptick in mortgage defaults and foreclosures could potentially trigger a cascading effect, causing the entire housing market to come crashing down. The gravity of this situation is further emphasized by the stark reality that during the previous housing crisis of 2008 to 2009, an increase in the foreclosure rate from 0.6% in 2006 to 1.8% of all housing units in 2008 was sufficient to precipitate a 25% plunge in national home prices. Certain cities, such as Las Vegas, experienced even more staggering declines, with prices plummeting by a staggering 60%. This historical precedent serves as a sobering reminder that the housing market is far more fragile than many realize, and even a seemingly small increase in foreclosure rates can have profound and far-reaching consequences. Contrary to popular belief, it took only a tiny fraction of homes, approximately 1 out of every 50 being foreclosed upon, to send prices into a tailspin during the last downturn. As if the foreclosure crisis weren't daunting enough, the housing market is also grappling with a severe demand drought. Mortgage applications to purchase homes have plunged to their lowest levels in 3 decades, while investor interest in the housing sector has also taken a nosedive. The number of homes purchased by investors in the fourth quarter of 2023 hit its lowest rate since 2016, a stark contrast to the surge in investor activity during the pandemic. Compounding these woes, home sales are plummeting, and buyer demand is virtually non-existent. Google searches for homes for sale have declined by a staggering 23% in just the past year, and when compared to the pandemic era, the drop is a remarkable 45%. With fewer potential buyers and investors in the market, the risk of homeowners defaulting on their mortgages or facing foreclosure intensifies. Already, defaults are on the rise across various consumer debt sectors, including credit cards, auto loans, and mortgages. However, the true extent of the distress among existing homeowners remains shrouded in uncertainty, with many cases likely flying under the radar. Reports of banks foreclosing vacant homes from low-income homeowners have become increasingly common, contributing to a growing shadow inventory of empty properties. Recognizing the severity of the situation, the White House has stepped in with a series of initiatives aimed at assisting homeowners and tackling housing issues nationwide. The Homeowner Assistance Fund, established under the American Rescue Plan, has provided aid to more than 500,000 homeowners who are in danger of foreclosure as of December 31, 2023. Additionally, states, territories, and tribal recipients have spent more than $6.6 billion to support homeowners. Other measures implemented by the administration include the Neighborhood Homes Tax Credit and the Down Payment Toward Equity Act of 2023, designed to make home ownership more attainable. Furthermore, efforts are underway to expand access to financing for home repairs, broaden eligibility criteria for housing programs, and provide assistance to homeowners facing foreclosure. However, these initiatives may face headwinds due to the alarmingly low savings rate among Americans, which currently stands at a record low of 3.8% of their income, less than half of the long-term average. The combination of soaring inflation, rising property taxes, homeowners' insurance premiums, rent, and grocery bills, coupled with stagnant wage growth, has left many households with limited financial flexibility. While government stimulus measures provided temporary relief during the pandemic, the cessation of these programs has exacerbated the financial distress experienced by consumers. As a result, mortgage defaults, credit card delinquencies and auto loan defaults are all on the rise, painting a grim picture of the economic pressures faced by many Americans. Despite these concerning indicators, the media and real estate industry have largely chosen to turn a blind eye to the harsh realities faced by struggling homeowners. Yet, the writing is on the wall. The current situation is unsustainable, and a wave of mortgage defaults and foreclosures is likely on the horizon. It is essential to recognize that the housing market and the broader economy can transition from relative stability to distress with alarming rapidity. During the last downturn, Miami's foreclosure rate skyrocketed from less than 1% in the first quarter of 2007 to approximately 20% within a short period, exemplifying the speed at which circumstances can deteriorate. While it is unlikely that any city in America will reach such extreme foreclosure rates again, even a more modest increase to 3% or 4% could have significant implications for numerous housing markets across the country. This risk factor cannot be ignored, particularly for those considering entering the real estate market. Some argue that the historically low mortgage rates, with approximately 85% of mortgage holders paying less than 5%, provide a strong incentive for homeowners to keep up with their payments, mitigating the risk of defaults. However, it is important to recognize that the housing market is currently experiencing a slowdown, and even a slight uptick in foreclosures could trigger a major crisis. Furthermore, the argument that homeowners in default can simply sell their properties and clear their debts, particularly in areas with soaring home prices, overlooks a crucial aspect of the foreclosure crisis. Regardless of whether a distressed homeowner sells or faces foreclosure, the end result is the addition of inventory from a source of financial distress. This influx of properties can exacerbate the imbalance between supply and demand, further destabilizing the market. Even in areas with historically low housing inventory, such as upstate New York and Columbia County, signs of trouble are becoming increasingly visible, with vacant houses and potential foreclosures serving as a microcosm of the broader national trends. As the housing market continues to navigate these turbulent waters, it is crucial for homeowners, buyers, and industry stakeholders to remain vigilant and informed. The potential impact of an increase in foreclosures will likely vary across different regions, and it is essential to carefully assess the risks and take proactive steps to protect against financial distress. Ultimately, while the government's efforts to support homeowners and promote homeownership are commendable, they may prove insufficient without addressing the underlying issues of affordability and economic stability for American households. A comprehensive and collaborative approach involving policymakers, lenders, and industry stakeholders will be necessary to mitigate the potential fallout from a foreclosure crisis and ensure the long-term resilience of the housing market. Thank you for watching this video. If you liked it, please give it a thumbs up and subscribe to my channel for more videos on finance and economics. If you have any questions or comments, please leave them below and I will try to answer them. See you next time.